Very happy Thursday to you. Welcome to our next edition of the Elville webinar series. And I'm Jeff Stauffer, Community Relations Director with Elville and Associates, and I'll be your moderator today. Our topic today is demystifying reverse mortgages and renovation mortgages, empowering your financial future. Presented by Marie Ritzenberg, mortgage advisor with Main Street Home Loans, and Tom Lauman, reverse mortgage specialist, also with Main Street Home Loans. This is our second in a three-part series with Main Street, and we really appreciate their partnership and the great education that Marie and Tom are offering us today. And we encourage your general questions as always, so please note them in the chat or questions section on your screen, and we'll pause a couple times throughout the presentation to address them. And your questions always add value and they help others learn, so please don't be shy in posing your questions at any time. And this morning by email, you received today's presentation slides that Marie and Tom will be referencing. These slides are also available in the section marked handouts in the panel on your screen to download at this time. And for our professionals on today's webinar, welcome and thank you for being here today. 1.5 continuing education hours are available for most everyone in attendance. If I don't have your ID or an accreditation that you'd like on a certificate of attendance, please send that to me if you'd like to earn CE for today's presentation. And everyone will also receive a post-webinar feedback email right after the presentation. So please take just a few minutes to fill out this brief survey and offer your feedback about today's presentation. And we read and value every comment that you have to share with us. And here at Elville and Associates, we're always here as a resource for your family and you, be it new planning that needs to be addressed, outdated documents that may need to be reviewed, or another matter. Steve Elville and his team are here to advise and counsel you every step of the way. And Marie and Tom have a lot of great information to share today. They'll share just a bit about themselves and jump right into the presentation. So I'll turn it over to them. And Marie and Tom, thank you so much for being here. We really appreciate it.
Thank you.
Thank you, Jeffrey.
Thank you everyone for joining us today. We'll give you a little bit of information about the company, myself and Tom, and our experience and history in the mortgage world. So thanks for joining us. If you do have any questions, please feel free to type those into the chat box. We'll try our best to address those as we go along, but we may also save some towards the end. Here's our contact information. If you'd like any follow-up or any information to ask directly, feel free to reach out. You'll get this information in your inbox as well. Main Street Home Loans, we are a division of NFM. NFM is a national company. Main Street is licensed in about 29 states. So we can help directly in mainly the East Coast, but we do have teammates that could help with your clients' financing needs for purchase, refi, and of course with today's topics, reverse and renovation, just about nationally. So that's one of the things that Tom and I both love about working here. Can help everyone, just not in specific states. We've got in-house underwriting. Our team is for the most part local, which means just direct control. You know, when we have a financial transaction, we need to make sure that our clients are taken care of, great service, the transaction's controlled, and many of us in the industry work on a referral-based business. So as our clients and partners are happy with our service, we want them to share that info and continue to work together. So today we're going to be chatting about reverse and renovation. I've been in the mortgage industry for 21 years, been working on purchase, refi, reno. We're seeing a lot of unique products nowadays with investors and investor products. So we'll have a seminar in a few weeks about that topic as well. But really, I just love helping people. You know, mortgages are only so exciting. And the joy that it can provide when someone is achieving a financial goal, saving money, that's always a good thing too, and just build a portfolio, that's very rewarding. Tom, would you like to tell them a little bit about yourself?
Thank you, Marie. Appreciate it. And thank you all for joining us this morning. I'm relatively new to the mortgage world, about 2.5 years in, and I've only been doing reverse mortgages. I don't do any forward or conventional mortgages. My background's in the investment world. I've been an investment professional for 40 years before I joined here. I understand risk. I understand the need for liquidity. I understand financial services. I understand financial planning. And that sort of was all dovetail to bring me to this. I think this product is extremely flexible and beneficial for our 62 plus borrowers out there, allowing them to utilize their housing wealth for a better lifestyle in retirement.
Perfect. So Tom, this is your section here. I'm going to hide my camera and I'll be clicking away. So there you go. Take it away.
Thanks, Marie. As I said, after 40 years in the investment world, I came to the reverse mortgage business, and like most of you out there, I was skeptical. I wasn't sure that the product was worthwhile or beneficial. But after doing a lot of research and speaking with a lot of industry leads, I realized and found out that after being re-regulated in 2015 by the FHA, HUD, and CFPB, reverse mortgages are now one of the safest and most flexible financial products out there for individuals. The FHA has added safeguards, one of them being a HUD counseling session that all applicants have to take before I can even take an application. They have to pass a certification in order to make sure that they understand the concepts, understand the costs, and that to avoid any elder abuse or that they're being forced into something. A lot of that miseducation and a lot of that unawareness led to a lot of the problems in the past, and where this product has a relatively negative stigma, and I'm still seeing that and fighting that, but that's fine. I'm happy to educate. But going forward from 2015, these products are valuable for borrowers over 62. And one of the main reasons is, going back to that other slide, is there's now $12 trillion in home equity for homeowners over 62 years old. Now, compare that to the stock market capitalization currently is approximately 50 trillion for all age groups. So even against all age groups, this is a significant amount of housing wealth out there for our senior borrowers. And if you just take it to the seniors or the people over 62, it's even much more significant. And that is important going forward as we are facing a time of increased healthcare costs, increased inflation, and also longevity. Longevity is the multiplier of all these other risks: market risk, inflation risks, healthcare risks. We're living longer, and people are outliving their savings. And this is one way of tapping into usually a resource that was left for legacy events. And I always say to people, you've built up all this equity over time. Why not use this as your first line of defense against all these problems and costs and longevity? So let's just jump into some basics about reverse mortgages. A reverse mortgage is a loan utilizing the built-up home equity as a source of tax-free funds. The government believes that this is a loan to yourself, so therefore the funds that you take out of your home are not taxable. Also, the elimination of monthly mortgage payments depletes the equity. In a regular mortgage, you're building up equity over time by making these payments to the bank or the lender. In a reverse, it's just the opposite. It's negative amortization. You're not making these payments, so therefore the lender is taking those payments out of your equity over time. It depletes the equity, but you're getting the present day value of the money in order to utilize it for whatever you want to do, tax-free. Also, it improves cash flow by eliminating your monthly P&I payments. You still have to pay your property taxes, you still have to pay your homeowner's insurance, and you still have to pay HOA fees if applicable. The loan amount is determined by three main factors. If you could just go back to the other slide, please. Thank you. The property value, the interest rate, and the age of the youngest borrower. These are built more like an insurance product with an actuarial table. So the younger you are, the less money you pull out of your home, because there's more risk or a longer time span to the lender. The older you are, the more you will receive. The most common type of home equity is the home equity conversion mortgage, otherwise known as the HECM, which can be a variable or a fixed rate. The minimum age of the youngest borrower must be 62, and the loan is capped about just over $1 million. This is an FHA insured product, and that's to protect both the borrower and the lender, and we'll talk about that in a little bit. Borrowers may also utilize a reverse mortgage for purchase. The borrower puts down between roughly 45 and 65% of the home value, finances the balance, but does not pay your monthly P&I payments, but pays the property taxes, homeowners, and HOA. But instead of buying something in cash, as most people in retirement would rather not have that monthly payment going out, you pay only, say, roughly even 65%, but you're saving 35% of the home purchase price that you can keep in savings and help yourself for further costs down the road. Let's move on to some terminology. Reverse mortgage terminology. It's a little bit arcane. It's not normal in the course of financing for the most part. But the main points that I'd like to bring to you is one of the main features is that they are a non-recourse loan. And this means that neither the borrowers nor their heirs are responsible for any shortfall if the home value at the time of the loan being finished, which is either leaving the home as a primary residence for whatever reason. If the home value is less than the loan balance, the borrower nor the heirs have to make up the difference. The lender is holding on to that, is taking that risk. And quite honestly, the FHA is actually then funding that shortfall, hence the FHA insured product. As I said before, these are negative amortization loans, which means that it's an equity depletion loan over time. That, as opposed to debt to income qualifications, reverse mortgages utilize a financial assessment. And this takes into a matter of willingness to pay, which it looks at your credit history, not your credit score, but a credit history showing the on-time payments and capacity to pay. And it deals with a residual income after basic monthly obligations are met. So it's a lot easier to qualify for a reverse mortgage than a conventional mortgage or even a cash out refinance. And as I mentioned before, one of the safeguards is this HUD counseling session. It's a non-lender affiliated counseling session, and this is ensuring that the borrowers understand the costs, the risks, the features of the reverse mortgage to make sure that there isn't any elder abuse or anybody is doing this without full knowledge of what they're doing. So let's jump into a scenario of a purchase. So a couple has an existing home, their mortgage value worth about $400,000. They have a mortgage balance of $100,000, and approximately their monthly P&I payment, their monthly mortgage payment is $1,200. And the age of the youngest borrower is 64. So they sell the house, they get $300,000 in net proceeds. Next slide, please. So what they did is they purchased a new home with a reverse mortgage, a one-story, easy to move around, better for their lifestyle as they age. Purchase price is $300,000, which they have from the other home. But instead of putting the whole purchase price down, they pay $150,000. They keep $150,000 for themselves. They're not making any monthly payments anymore. And with the proceeds, they purchase a single premium long-term care policy, let's call it $100,000, and they supplement their retirement portfolio with the leftover $50,000 from the $150,000 they saved. And let's see what the results are from this. They moved into their forever retirement home. They funded a long-term care policy, single premium policy. They supplemented their nest egg. They increased their monthly cash flow by the $1,200 that they're not paying anymore, and they have peace of mind. This is one of the great things about reverse mortgages are the ability to take away some of the catastrophic costs going forward by buying a long-term care policy, by making modifications to age in place if need be. These are things that are trying and bringing at-home care into the home instead of having to go to a facility, which nobody wants. These are the great things, and this is what I love about the flexibility of the product, how it can help so many people as they move on in through their retirement age. If we just real quickly get to the next, now go back, misconceptions. These are things that have been out there forever. The first reverse mortgage was done in 1961, small bank in Maine, and they just grew from there. However, they weren't re-regulated until 2015, and that's when they're really strictly and they're regulated. They're one of those safest products now for individuals. So one of the great misconceptions out there: the bank will take my home. This is not true. The bank is not on the deed or title. The home is collateral against a loan, similar to a regular mortgage. In a regular mortgage, the bank is not on the title, the lender's not on the title. You are just making payments to them. The home is the collateral. The borrower maintains ownership as long as they continue to make their property taxes and homeowners insurance payments. Another misconception is my heirs will be responsible for repaying the loan. As we talked about, these are non-recourse loans. That means the heirs are not responsible for any shortfall. I will leave nothing to my children. This is a long-standing belief that the home has to be the legacy to their children. This is what we're going to give you. Unfortunately, nowadays, not many people live in the same area with their children. The children don't want the home. They don't need to have their own home. It becomes an estate planning hassle to deal with the disposition of the hard asset. And they think that this is the only thing they can leave. Whereas there have been studies showing that if you utilize a reverse mortgage and you pull the money out of the home, you can invest it, you can get a better return than the home appreciation over time. You may increase the home, the value that you give to your children. Also, if there's any residual equity left over from the sale of the home, if there is no financial shortfall between the loan balance and the home, that goes to their heirs, just like a regular mortgage. And the last main misconception out there is that I heard that a reverse mortgage leads to foreclosure. As I said, in 2015, with the re-regulations, the HUD counseling and the financial assessments, the percentage of reverse mortgages foreclosing are now down to about 2%, which is roughly the same with conventional mortgages. So these new industry standards have really created a much safer and better product for homeowners over 62 that would like to utilize their housing wealth. And one of the many things, next slide talks about the utilization that you can use with the funds from a home, from the home.
There's actually a question in the chat box about what happens if I want to sell the home. You might be getting to that in this slide, but just wanted to mention that question.
No, thank you, Maria. I appreciate that. If you have a reverse mortgage and you want to sell the home, you sell the home, just like a regular mortgage. The loan is paid off, and whatever equity is above and beyond that goes to you or your heirs. However, just like we said, it's non-recourse. If there's a shortfall to the loan value, to the home value, you don't have to pay that difference. But they work just like a regular mortgage when you sell your home. Reverse mortgages can be utilized to refinance the home, pull cash out. You can monetize in a liquid, historically slow growth asset. Equities usually grow roughly 10 to 12% over time. Homes, now the percentage is about 4%. If you put money into the market, 10 years, a lot bigger growth compounded over time in the stock market than there is in the housing market. You can utilize the funds from a reverse mortgage to pay for a Roth conversion, if that's what you choose to do. That tax on a Roth conversion can be quite substantial. Pull the money out of the home to make that happen for your benefit. A lot of people use the reverse mortgage to defer Social Security payments to wait to get to 70 years old to maximize it. You can utilize the reverse mortgage as a bridge loan. You don't have to take all the money out of the home. You take part of it out for a certain period of time. You can purchase a long-term care policy, pay their premiums, or defray private care costs for people that need to stay or would like to stay in their home instead of going to a facility. You can fund age-in-place modification costs and modifications. Somebody's in a wheelchair now, putting in ramps, lowering counters, widening doors. You can fund that so if you want to stay in your home versus moving. You eliminate your monthly mortgage payments. It's one of the big things for cash flow. You increase your cash flow at a time when you're on more of a fixed income. That's really, really beneficial to seniors. You provide tax-free supplemental monthly income. You can pull it out like an annuity. You can add tax-free monthly income to your Social Security or your investment account withdrawals. You can also have a line of credit utilized, and that is the only borrowing instrument where the line of credit borrowing capacity, the unused portion of it, increases and compounds over time by the rate that the used portion is tapped. So this fund can grow as it doesn't just sit there, let's say like a HELOC. This fund actually drains borrowing capacity over time if you don't use it, and allows you to pull out greater funds later. And for the investment professionals out there, you can manage sequence of return withdrawal risk with this product. You have the line of credit. During down markets, you fund a lifestyle through the line of credit, and you don't take money out of the investment accounts. You don't deplete the base on the down markets, and therefore, and then when the up markets come, when the market comes back, then you can start pulling the money out of the investment accounts, and you leave your equity, your home equity alone. You can that improves sequence of return risk and withdrawal risk solutions. You can also improve investment returns through the strategic coordination during down markets. It's very much like I just said, that you just saving the assets. You're preserving the wealth that you've built up in the investment world, and you're utilizing your housing wealth for your benefit in these down times. Speaking of benefits, on the next slide. So the basic benefits are you improve. You just go back a little bit, Marie, if you don't mind. There you go. Thank you. You're improving your monthly cash flow by eliminating your mortgage payments. You're monetizing a liquid asset. It's hard to do that otherwise. You have to wait for a sale. And most people don't want to sell their home. You're monetizing as a liquid asset for your benefit, for any purpose. You can buy a boat. You can fund your grandchildren's education. You can travel. You can fund a foundation, a charitable foundation. You can do. There is no limit to the purposes that you can use your funds for. You manage all forms of wealth, not just your investment wealth. Your housing wealth is important too and substantial. This allows you for greater flexibility, greater diversification, and greater risk management. You're tapping housing wealth while alive to comfortably age in place. That is one of the great benefits I get. I get self-actualization out of the fact that I'm helping people live a better life in retirement. It's really wonderful to see people that are getting more at-home care if they need it, to fixing up their house to make it easier to live in as they age. You're downsizing or right-sizing to your retirement dream home and preserving capital at the same time. You're proactively addressing your needs and desires in the face of the multiple forms of risk that are out there. Inflation, taxes, market, healthcare risks, utilizing tax-free funds. And as I mentioned, longevity is the multiplier of all these risks. And the bottom line is you're improving your lifestyle in retirement by utilizing reverse mortgage. Thank you. I can take a few questions now if there's any, before Marie gets back into the renovation loans, or we can wait till the end. Okay, Marie.
Perfect. Thank you so much, Tom. And
Sure.
feel free to keep typing any questions as we go along. We're going to move on.
Marie, I think we have one question.
Oh, there it is.
From before there about can the home be a trust-owned mortgage?
Yes, it can. They're a little bit more. There's a few more hoops to get through to get it done. But yes, a home can be a trust-owned. It can be a trust-owned mortgage. Yes.
Perfect. Okay.
And it looks like maybe one more here.
Okay.
Let's see here. if okay, maybe I'll just mention it, discussing the risks possibly regarding variable rate products and the possibility of rates going up.
You can do a fixed rate if you so choose. Most of them are variable rates, and these can be refinanced just like a regular mortgage. So if you feel that rates are going to go higher in the short term and you want to be on a fixed rate, you set it up as a fixed rate, and then if rates drop enough that it makes it worthwhile, you can refinance it to a variable rate. I see the one, let me see this next one, hold on. Maximum loan to value ratio for a 62-year-old. It's probably 35% for a 62-year-old, only because of the longevity factor. The lender's taking so much more risk. People could live to, the tables go to 99 years old. So the formula, the algorithm gives them a lot less at 62-year-olds. So I would go to the bottom edge of the range of 35%. Second question there is, what is the implied interest versus traditional mortgage? The mortgages, there's probably not much of a difference. It's about 1/8 of a point in between. The fixed rate's higher because of the length of the loan and more risk to the lender. But the variable rate is usually just about 1/8 of a point difference. And what happens when equity becomes negative? Yes, that's the non-recourse factor in these loans. The investors take on the risk. However, the FHA backstops the investor's risk. So the one downside of these loans are the high upfront cost, the closing costs, because the FHA puts a 2% upfront mortgage insurance premium, 2% of the home value, not the loan, but the home value. That's a fairly significant number, but that 2% funds all these loans to be non-course, and therefore take away the risk to the borrowers and the lenders. Otherwise, lenders would not make these loans. If you buy a retirement dream home with a reverse mortgage, you then have both homes, right? No, I should have mentioned that the one thing that is necessary for a reverse mortgage, you have to live in the subject property as your primary residence. That's where the reverse mortgage is on your primary residence. You can pull proceeds out of your primary residence to fund a second home, but you cannot do a reverse mortgage on a second home.
So like you could buy the second home in cash, quote unquote, from the reverse mortgage that you took against the primary.
Correct.
Yes.
Generally are reverse mortgage rates lower than home equity rates? No. No, home equity rates are probably lower, most often. But you have less flexibility with them. And I would say, Marie and I were talking about this earlier, if you're doing, time is a factor for the reverse mortgages. I always say, if you're not going to be in your primary home for more than 3 years, you probably should not do a reverse mortgage, because the cost benefit isn't working in your favor, because they're expensive at first. So it's the length of time that rewards you for utilizing a reverse mortgage. Otherwise, they're just too expensive. You can probably do a different financing or sell the home just outright, if that's the case, if you're going to leave in 2 years.
This was not asked by the group, but just maybe a quick question about a prepayment penalty. So if they, take out the reverse mortgage and they're in there, and they think they're going to be in there long term, but they're only in there for 2 years, and for whatever reason they need to move, is there a prepayment penalty or anything of that nature someone should be concerned about?
No, there are no prepayment penalties with these products.
There's another question that just popped in.
Upon my death, will my disabled child be forced to sell or purchase? If they're on the deed, no. or that's probably more of an inheritance issue, in my opinion. I'm probably not, I'd have to see what if they're on the deed, how that is structured before I could make a decision on that.
We had done a class or a webinar last month that was specifically about the family opportunity mortgage, Tom.
Mm-hmm.
So that was, you know, a big topic of discussion. Because the youngest borrower has to be 62, you know, assuming, let's just say in this case, the disabled child's under 62, but the parent is over 62, the disabled child would not be on that mortgage, correct?
No, but they could be on the deed.
Right.
And I should also mention, you can have a non-borrowing spouse that's under 62 that is then on the loan, and they get all the benefits. They get to stay in the home. Say you have a 75-year-old or 62-year-old male, and his wife is 50. She can stay in the home as long as it's her primary residence and she's making the property taxes, homeowners insurance. If there is an annuity stream, or if there's a ongoing income coming out of the loan, she will not get that because she's not a borrower. However, she will not be forced to sell or move out of the home.
Perfect. Okay. Looks like we've addressed all of the questions thus far. We'll be happy to continue to address them, but we'll certainly have an additional Q&A session at the end as well. So we'll be moving on to renovation loans now. And Tom, you're good. I'm just on camera if you want to do mute perhaps. And you can unmute and jump on as needed, of course. So with renovation financing, it's a great way to look at purchasing or refinancing real estate. In our current market, we know that there is an inventory issue, a lack of inventory. So when you look at things from a different angle, property may have a great location, but it's not turnkey. You know, it's got the original kitchen and an unfinished basement, and we would like to finish the basement, remodel the kitchen, and open up that first floor. You can look at it from that different angle, and renovation financing can help a buyer purchase a property that, you know, may be sitting. It may have different reasons that they would need renovation just to complete a purchase, but also it can be used for a refinance if you own a home and you want to refinance and make an addition or complete those renovations. So on average, homeowners spent about 15 grand on home improvements in 2020. The average new homeowner spends about 10 grand in renovations and repairs in the first year. You know, sounds like it could be a tough pill to swallow if someone doesn't have that fund in the liquid account, but renovation could be a great way to address it. About 38% will put renovations in the product on a credit card, a secured loan, or personal loan, or even 401k. So that can certainly be a risk that could impact their credit scores and their financial goals in the future. Millennials spent about 60% more on home improvement in 2020 than in 2019. Now in 2020, interest rates were quite a bit lower. It certainly was a bit more of a seller's market in 2020 than in 2019. So many buyers likely were not as picky on the property, or may have waived certain requests or desires just to achieve that goal of obtaining a home. In 2020 and 2021, that reshaped how homeowners interact with their property in key ways. They're spending more time in their home, obviously, during that period of time, wear and tear on the property, and then also realizing, hey, we're working remote, we need more space. I love you, but I don't want to work elbow to elbow. So that is certainly something that made people more aware of what they need in their home if they were living in it and or working out of it, educating in it more than usual. Of course, during that time with COVID and those health risks that put local businesses and economic restrictions in place. I was remodeling our kitchen in 2021 into 2022. And I just recall having to start that planning very early, purchasing very early because of, the cost of products increasing and also the limited availability. So planning is all proper when it comes to the renovation. So with renovation financing, what, why, and how? So what's a renovation loan? Basically, renovation financing allows a borrower to purchase a home or refinance a home with less than ideal condition and make home improvements immediately after closing. So for example, it could be, a property that could be distressed, perhaps a foreclosure. Perhaps it has some health and safety issues that a traditional mortgage wouldn't normally like. A traditional purchase mortgage, the lender usually wants to see that the home meets the standard health and safety criteria for a client to purchase and live in that property immediately. If it's a renovation loan and let's say it needs a new roof because the roof was leaking, which caused water damage, which then caused mold, for example, we're not going to let the client move right into that. That's a health and safety risk for us. So they can overcome that roof, water, mold, and perhaps maybe the HVAC needs to be updated too. Those can all be financed in the purchase and the renovation financing structure. So why does somebody need to think about renovation or consider it? So basically, a home buyer, as mentioned, they can address any immediate concerns. They could make it just, the cosmetics, the kitchen and bathrooms are ugly and outdated. I want them to be newer. There's nothing wrong with the home. It's got good bones, it functions, but I want that specific, looking kitchen or bathrooms. For a current homeowner, this could be a great way for them to finance the cost of the renovations to bring their home up to market condition and give themselves the best return on their investment. So they can take advantage of that renovation refinance to prepare the home and renovate it to then list. Or if you want to make an addition and continue to live in the property, it certainly is a great way to make the home the way you want it to be. We'll also chat briefly about aging in place, since that's a topic today too. If the property just needs to have some additional accommodations, you could utilize the renovation mortgage to complete those aging in place accommodations. This can also be used for other types of occupancy. It does not have to be just on a primary residence. It can also be used for an investment property or a second home as well. There are certain types of financing and types of renovation loans that we'll dive into, but the occupancy will determine which loan type someone can get for renovation. Let's see, how will the renovation loan help someone like a realtor, for example, sell more properties? Or even if we have our estate planners here, if someone's interested in, hey, we need to address these following items, perhaps we should do the renovation loan to take care of said cosmetic item or health and safety issue, they can take advantage of that opportunity. And it's also a myth that many people think that a reverse mortgage for purchase is usually two loans. It's not, it's one mortgage. So they're taking out the mortgage to not only complete the purchase, but also to complete the amount of renovation. So it's all in one loan. One of the benefits is that we are looking at the after improved value. So for example, if we see this property that's listed for $500,000, for example, and if it needs $150,000 worth of renovation work, then we have an acquisition cost at $650,000. The loan type requires a down payment anywhere between 3.5% to potentially 5% down. So that down payment of 3 to 5% is going to be based upon that $650,000 acquisition cost. When we appraise the house, we're looking at the home's after improved condition. So when the appraiser goes out to the property, they're looking at the home in its current state. We provide the appraiser with the bid from your licensed and insured contractor of your choice to show, okay, this is the work we're going to be doing. This is how we came to this total cost of the $150,000. And they appraise it based upon what it will be worth when the renovations are done. So although our acquisition was $650, will it then be worth, $700 or $725? So we're appraising it based upon what it will then be worth. That is a really nice option for our clients that also already own the home that want to refinance. Because if you don't have enough equity in the home right now to do a cash out refinance or to add a home equity line of credit, like Tom had mentioned, a home equity line earlier, if you don't have enough equity to pull that fund out to complete that renovation work, you might not be able to complete the entire project because you're looking at the value of the home in its current state today. But the renovation loan works where it's looking at the after improved value. So if it's at 500 today, you want the 150 worth of work. Well, if you owe, let's say 450, you don't have enough to pull out to do that $150,000 project. But because the way renovation works at the after improved value, that gives you the flexibility to address and access what you need. So the vision, look at it from a different angle. If it's a homeowner or a realtor with a listing, could this be a challenging sale? It's a great location, but it needs some TLC, or as is, estate sale. There's different reasons. People may address in the comments saying, investor special, handyman special, REO, real estate owned, or foreclosure. We're not seeing too many short sales, but I have seen a couple as of late. Then of course, if the property's been sitting for a little while, if the homeowner is not getting offers, this could be a great way to update and renovate the home and then come back to market once the renovations are done. Or if you yourself are a buyer or have a client that wants to be in a specific area, specific location or neighborhood and just can't find that home to suit their needs, well, you can't change location, but you can change the cosmetics and you can change the footprint of the home. With renovation, you can actually knock the home down and demo it. However, you have to keep the foundation. If the foundation is removed, now we're looking at new construction. So you could take it down to the foundation, build it up, build it out, and utilize the renovation loan as part of that. Let's see here. These are just some different reasons why somebody would want to consider renovation financing. The types of renovation financing. So you may have heard FHA 203K versus limited or streamline. So those are both under the FHA umbrella. There's also conventional or the home style. That's a conventional product. And we also do offer a VA renovation loan, which is really nice for our veterans to make the home the way that they would like as well. So we've had access to majority of these products for years, but we've recently acquired the VA option, which is wonderful. So describing the types of the renovation financing for FHA, the 203K standard versus limited. Both with FHA, it has to be a primary residence or owner occupied. That's also with VA as well. So government loans are owner occupied properties, whereas the conventional products could be used for certainly a primary, as well as an investment property or second home. Excuse me. In regards to how much can we finance, it really is dependent based upon location. There are loan limits for each area or county. So we have to confirm based upon that area, how much can they actually finance based upon that criteria county. FHA is most forgiving when it comes to credit score and credit history. On a standard purchase, non-renovation, we can usually offer as low as a 500 credit score. Terms become more attractive when we get to 580 and above. We're normally looking for ideally 620 to 640 on renovation financing. As mentioned, of course, it can be used for purchase or reno because there are additional steps like getting that bid from your contractor. The appraiser has to look at the after improved value. And we do have to get that contractor approved and basically do like a background check just to make sure that that contractor, is legit, they're a good job, licensed and insured, they're going to complete the job, all that. We want to make sure that we get them approved and vetted. So instead of a standard purchase being give or take 30 days or so in today's market, They're usually a bit less than 30 days for a standard purchase, but on renovation, we're usually looking for a solid 45 to 60 days just due to the additional steps needed. You can actually utilize this on a multi-unit property, which is really nice. You can utilize it on 1 to 4 units. So if you see the opportunity for a multi-unit home, let's say you're going to live in, it's a 4-unit property, you'll live in one of the units and rent out the other 3, you can renovate all 4 units with this product too. Let's see here. You can also utilize it on manufactured homes, condos. With condo communities, we do have to make sure with government financing, FHA and VA, that the community is FHA or VA approved, but you can utilize it on condos. And pretty much everything is able to be included in a renovation except for luxury items. So if it's like health and safety, cosmetic, that completely is viable. And the misconception of, does this have to be a historic property? It does not. It can be, really at any age. Just checking the chat box for questions here. So with renovation financing, if we're doing a standard reno loan, standard means it's above $30,000 worth of work, and or if the property has some health and safety issues, we'll need a standard renovation loan. A streamline or limited is when it's under $30,000 worth of work, and it's mainly cosmetic. There's no health and safety issues. So when we have the standard reno, FHA 203K, we do have a HUD consultant that works with the buyer during that process. They're basically holding the client's hand just to make sure everything's going to be going smoothly, babysitting the transaction just to make sure that everything is in proper order. They're the consultant to make sure that we're meeting FHA criteria. So they'll meet with the inspector. They'll make sure that the numbers and the job lines up. They'll cross-check and make sure that the cost is viable. Back during, I guess it was 2020 or 2021, when the cost of lumber was 4 times as much as it usually is. I had a client with a bid, and the HUD consultant came back and said, I don't know how they're going to complete this project with the current cost of materials. We really need them to update this bid to make sure that, if anything were to happen, we can get another contractor in here to complete the job with true cost. So we were able to work with the HUD consultant and that contractor to get everything finalized and updated to make sure that it was in line with true cost. Let's see here. They'll also complete the estimate to make sure it looks accurate. They'll review the bids as mentioned, and then they'll complete the draw. So after the draw is complete, they'll go inspect the property and make sure that all the work is completed, and we'll close out the renovation draw account. So let's see here. Perfect. We'll talk about the draw account in just a second here as well. So in regards to repairs, standard repairs, eligible versus ineligible. So as you can see in the left-hand column, pretty much everything could be included for eligible repairs. Structural can be done, can alter, make an addition. If it doesn't have a garage, let's say it's got a carport. You see a lot of that here in Howard County and Columbia specifically. If you want to convert that carport to a formal garage, you certainly could. Remodel kitchen and bath, switch up the floor plan, knock down walls, open it up. Of course, you can add appliances, even HVAC, plumbing, and electrical. You can repair an in-ground swimming pool, but in the ineligible side, you cannot add a new swimming pool. So if one exists, you can repair it. So as you can see, there's plenty of different reasons why you could utilize the renovation product. In regards to the ineligible items, so those luxury items would include, putting in that new pool, gazebo, tennis court, commercial improvements, an outdoor kitchen. Those all sound lovely, but Reno would not let you add those items. In regards to the limited, this is, as mentioned, it's more of the cosmetic items, nothing health and safety, no structural. And I did mention 30 grand worth of reno. it's technically 35 because there's usually a 10% contingency. So if we add the 10% contingency for cushion, plus some additional fees, it would usually be 35 grand total is what could be financed. Let's see, and then you can occupy the home immediately and start the renovation immediately as well. All right. So the comparison of the standard versus limited. So the standard 203K minimum has to be at least 5 grand. And that mainly could be, you know, if it has that water damage or if the HVAC isn't working. And if it's sold as is, if it only needs 5 grand worth of work, but if it's in that health and safety category, we would still require it to be the standard rather than the limited. Limited is less than the 35 grand worth of work. The scope, so the scope for the standard is usually, you know, pretty significant rehab, whereas the limited is repair, remodel. Both can be used for purchase and reno. In regards to the number of draws, so the way that it works is if it's a purchase, you close on the day of settlement. The client gets the keys. The funds for renovation are put into a draw account. So let's just utilize this example of that 150,000 we had mentioned. That 150 is put into a draw account so that the funds can be used to start with the purchase items like the cost of materials. So this one where it's the max number of draws of up to 5, the contractor might want a certain portion to start purchasing the materials and the supplies to get things going. And then they can have a total of 5 draws throughout that process to complete the purchase, to pay their staff. And then when everything is done, the HUD consultant would go out to the property to confirm it's complete and close that draw account. If there's anything left in excess, that would get applied towards the loan, the principal loan, a principal curtailment, so that they would be owing less than what was originally planned. I also mentioned that there's a 10% contingency reserve because, you know, there's nothing like a surprise when they're doing, you know, the work and find that, hey, as we tore down this wall, there's a surprise. We need some additional funds to complete project X. Or the cost of materials may have increased. So for those specific reasons, there's that 10% contingency reserve for the unknown. Whereas the limited, there's just the one draw. So it's usually just very simple. With the limited, we're usually looking for the contractor to fund the cost of the purchase order and complete the job, and then have the draw paid out when the job is complete to then show that the renovation is completed. Let's see. And the nice thing with the standard is if the home's not habitable, so let's say the client is renting or even owning their current home and the new home is going to be, you know, a full job where they don't want to live through that construction, you can finance up to 6 months worth of mortgage payments into that loan. So you don't have dual housing payments, which is really nice. If they've got, let's say, a $2,500 rent or mortgage payment now, and the new mortgage is going to be $3 grand, can they withstand a $5,500 housing obligation prior to utilities? It's certainly convenient to finance those 6 months. They can certainly utilize this on HUD or REO foreclosures. And we do not allow self-help, meaning, hey, I think I can do part of this job on my own. Well, we want the licensed and insured contractor to do the full job. So we require the client to work with licensed and insured contractors throughout the process. And I'm going to jump to the chat box here. Let's see. Can a rental loan on a primary home be used to help finance a new build second home, or is it a construction loan with a better option? So in regards to, so reno can be used, the FHA reno can be used on a primary residence. That lien is attached to that property. If we were looking to help finance a second home, We would probably look at perhaps a home equity line of credit or a cash out refinance, because those programs can be used to help finance the build or acquisition of a second home. So depending on how much equity the client has in the current primary residence would determine how much they can access for that next goal. And if they need access to more funding, then perhaps a traditional mortgage or a new construction mortgage for the next property may go hand in hand with a cash out refi on the primary or home equity line on the primary. So the reno loan is very specific, addressing the specific renovations that you're doing to that specific property. So we can also utilize the renovation on a second home or an investment property. So if they own their current primary residence and then they find the vacation home can be utilized either as a purchase or refinance with that renovation loan attached to that specific property address. All right, there's one more. I'm really interested in pre-project counseling. Okay, so the pre-project counseling, we can certainly provide the list of HUD-approved counseling agencies. Some of them are completed online. Depending on the loan type or additional layers, like if someone were getting down payment assistance funds, they may need to take the homebuyer education counseling with a very specific locale. So we can certainly provide the general information about the HUD approved homebuyer education counseling. And some of these would be used for a standard purchase versus the reverse mortgage versus the renovation mortgage. So we could certainly get you those details as well. All right. So moving on to home style. So home style, that's the conventional product of the renovation. So you don't have to work with a HUD consultant, which is convenient. We do require a consultant if a bid is over $35,000 when utilizing the renovation product, or if there's structural repairs needed. Material costs, 50% of material costs are allowed as an upfront draw, which is great. Again, no self-help, no luxury items. You'll see a recurring theme here. We want you to work with licensed and insured contractors. We don't want to give you the funds to complete the work yourself with a renovation product. And we just want to make sure that it's going to provide value to the property. You can utilize this on single family homes, condos, and even multi-unit, and the occupancy can be owner occupied, investment, and second home. As little as 3% down payment on the acquisition cost is required if you're a first time home buyer. If you are a repeat homeowner, then normally a minimum of 5% down is the required down payment for a primary residence. And this is the down payment based upon that acquisition cost. As mentioned, price plus reno equals acquisition. If we're looking at a multi-unit property, then the down payment would usually be 5% if it's an owner occupied. If we're looking at an investor investment property, 15% down payment is required, and a second home is 10% down payment. So the occupancy will play into the required down payment on a purchase. If it's a refinance, then there is a limited loan to value that coincides with it being that type of occupancy. Okay, moving on. VA. So VA is wonderful for our veterans. We have to confirm that they are, in fact, eligible for a VA loan. This can be used for repair and cosmetic repairs, cannot be used for structural, and the work has to be completed within 120 days or 4 months. In regards to the amount, there's no minimum, but the max is 50 grand. The contractor has to meet all licensing, bonding requirements, and we actually have to get the contractor approved by VA. The The bids have to fall within the customary, usual and customary range for the scope of work, as is approval. And the contingency reserve is 10%. If there aren't any utilities on, we're going to give some additional cushion to make that 15% rather than the standard of 10. Better to have too much than too little, and we'll always reapply any excess funds towards their current mortgage balance. And then the draw disbursements, those are progressive payments as the work is completed. So that's nice as well. So with the renovation, the financed escrow account, basically we're putting the funds into that escrow. The contingency reserve, on average, 10 to maybe even as much as 20%, depending on the specifics. We do have draw inspections, so there is a fee that goes into the total amount financed because there are inspections that are completed, title updates, the HUD consultant fee. We can also add permits, architectural fees. So added fees that a client would normally need to pay out of pocket can be utilized and financed into the escrow or draw account. So that way, if we're looking at a couple of grand worth of permit and architectural fees, instead of the client paying those out-of-pocket expenses, that can be included in that total draw. So that's very helpful. As mentioned, if the property is not habitable with most of the products other than the FHA limited, the client can finance up to those 6 months worth of payments just to decrease their overall monthly budget. All right, so purchase a home with renovation financing. So if it's a homeowner or home buyer looking to purchase, obviously we want to get them approved. We'd have to get their application, pull credit, review income, assets, debt load, get them qualified. We're going to be looking at the, acquisition cost, purchase plus renovation. So if I have a client that's approved to $400,000 and they're looking at properties of $400,000, they really don't have any room to qualify for a higher amount to do the renovations. If they're qualified up to $400,000 total, then depending on the scope of work that needs to be done, maybe they're looking at homes at $300,000 or $350,000 with the cushion to finance the renovations to get them to that total of $400,000. We want to look at, their payoff. What's the payoff going to be with the work? We want to make sure that it's going to provide value to them and improve the value of the property. In regards to getting them approved, next steps, look and find the property. Once they address the property of interest, submit the offer or convert into a contract. It is nice from the seller's perspective. The seller, doesn't normally have to worry about home inspection items, the condition of the home. They may be selling it as is. The renovation loan could be perfect to overcome any repairs that the seller might not be in a financial position to fix. In addition, if we have, an estate sale, that might make things a little more complicated in figuring out who's completing work. Whereas if the buyer addresses, I'll complete all the work myself, that makes it a lot easier for the seller side. Seller concessions, meaning a seller credit to be applied towards closing costs. Sellers can give an average of 3 to potentially 6% on average towards the buyer's closing costs. Depends on the loan program and the loan to value, but the seller can give them a credit to help alleviate some of the out-of-pocket expenses. As mentioned, 45 to 60 days, so a homeowner or seller would have to be prepared. We're not going to close this in 2 weeks if it's a renovation loan. And instead of having an inspection addendum, we would have the renovation contracted addendum, just so that the homeowner knows, hey, this buyer's doing renovation financing. We may have to access the property a couple of times so that they can get their contractor into the home to get that scope of work complete. We'd send the file to processing and underwriting, get them the full application fully reviewed, get the contractor bid and the work write-up. So we'd have to get that bid in hand, make sure we have all the details needed. Depending on the loan type, we might need some additional work write-ups or additional bids. The appraisal cannot be ordered until we have that scope of work, because we need to know what it will then be worth. Once we have all of that paperwork, we're going to get the file into processing and underwriting to get loan approval. Underwriting will issue loan approval commitment and make sure that everything's been verified for that client. We're then going to finalize the scope of work, get the appraiser out there, and as long as we have the appraisal back and everything looks great, we're going to send the file back to underwriting for the final approval and clear to close, our favorite words in the loan industry. And in regards to settlement itself, closing takes place. We've got 15 days for the first draw. The buyer has the key in hand. They can move in if they're ready, but the work can start at day one, getting the permits drawn and everything there. In regards to the draw process, like when is the money going to be dispersed? So it's going to be different on each of those loan types. So with standard, we have to, with the limited, we would have the lender call the draw center and request the draw inspection. With the standard, the HUD consultant is the point of contact for those draws. And ideally, draws should be done, give or take, at least every 30 days. We'll have to update title once the final draw is complete. Depending on the loan type, we could have or utilize 6 to 12 months worth of time to complete the renovation. Sometimes things take a little longer than usual, permits, back orders. As long as we're in communication with the homeowner and contractor, we'll give the client the time that they need to complete the work. We'll complete the final inspection. If there's any contingency funds, we'll utilize those. And if a change in the contractor is needed, we can do that. It's just a lot of communication to say, hey, this contractor might not be meeting our needs. We've got to find a new contractor. We can switch that contractor. We do have to get them approved. Just looking for questions as we move on. So Reno is really just a great problem solver. It can help utilize the ability to find a great location with a home that needs some TLC or renovations. You can make the addition if you want to add the in-law suite, bring family into the home. Now we have the addition to allow more family to live under one roof. We're seeing that a lot lately. Could be great for a listing or a home that may be a tough, challenging sale. And then of course, if somebody is looking to renovate and improve that property, it's a perfect opportunity to stay in a good location, proper neighborhood that you want to be in that suits your family's needs, but make that what you want it to be. If a realtor is involved with the renovation transaction, the contractor is going to be in touch with the realtor to get access to the property, as well as the consultant to get into the home. If needed, the realtor can potentially help the client with a recommendation for a contractor. We do have contractors that we've worked with in the past with a great success rate. However, it's a risk if we provide a list of quote unquote approved contractors, you know, that we want the client to pick their own contractor of choice. And then of course, if the realtor is involved with the negotiating of the offer, we want to make sure that communication and expectations are set and that we provide the seller and potential realtor or attorney on the other side. The closing is going to take usually that 45 to 60 days. We've addressed some of this before. It can help with, you know, a listing that needs some TLC. The seller doesn't have to make repairs, so that's always wonderful. And of course, with aging in place, you can also utilize the renovation loan to complete those items that could help make the current home more accessible and utilize those features to the client's needs. So for example, if we have that property at 500 grand, if the client owns 450 and they need 150 to renovate it, well, they only have 50 grand in equity based upon the 500 value and what they currently owe. So if they're going to try to refinance or do the home equity line, it's not going to give them the opportunity to fund that 150 that they need in the full renovation. So with the renovation loan, they can finance that full 150. So their acquisition cost or total finance now is $650, but once all the work is done, it's going to be worth $700. So that's a great way to utilize renovation on a home that you currently own and make it what you want it to be. And then I also included a couple of links for aging in place here in Maryland, as well as specifically Howard County. We can find some additional locations if you guys need additional information. But there are some grants that currently exist coming close to the end of the fiscal year. So don't be scared when you click on the links and you say, hey, these end at June 2024. They will be renewed and refreshed at the fiscal year, July 1st. But this is for Maryland as well as Howard County with some grants and tax credits as well for aging in place. And that's all I've got for now. What questions do we have?
Okay, Marie and Tom, well, thank you so much. Lots of outstanding information and resources. So now would be a great time for any final questions that you may have for Tom and Marie. Please note them in the questions panel or the chat section. Get them right over to Marie and Tom. And while you're doing that, I'll mention I'll be sending out some information, as I always do, after our webinars, including Marie and Tom's contact information, also the recording from today and the slides again. I'll also send out the webinar and slides from the Family Opportunity Mortgage webinar that Marie offered recently. And that was a great one if you missed it. Also, information about tomorrow's advisors forum, our quarterly advisors forum that Steve Elville offers here through our webinar series. We're going to be talking about the new Corporate Transparency Act and what advisors need to know about this to be a resource to their clients. So I'll send out the link to that. That's going to be at 10 o'clock tomorrow. And we also offer continuing education hours for that. As we move forward with the webinar series, we do typically take a break in July, and we're going to do that this year as well, but we'll be back in full force in August. And included in August, we're going to have Marie back again on August 15th to finalize our three-part series. I'm sure we'll be doing more in the future, but for now, we'll be talking about planning for the future and retirement using real estate as a vehicle. So we'll have further information about that real soon. So check to see if we have any final questions here. I think you answered everything. So,
Can I just make one addition that I left out?
Absolutely.
Steve? Jeffrey, just also reverse mortgages are great. This is for the attorneys in the room for hard asset disposition in estate planning and in silver divorce. It should be considered as another tool in those processes.
Great, thank you.
Thank you.
All right, Maria and Tom, thanks again for being here, and to you, thanks for being part of the Elville webinar series. We'll see you again soon. Have a great day and stay cool out there.